Okay, so on the 3rd, I posted our demo problem on petty cash, all right? And I also posted this handout. So I'm going to encourage you to work through that handout. This is question 2 on the chapter 6 handout that I posted on Friday. All right. So my strong advice as it relates to comprehension is that you review the content for Friday if you haven't already, and then try to work through this question on your own. Right. And of course, I will have posted the solutions in the Excel file so you can access that and see how you did. And if you still have questions, definitely utilize this. Or if you can't think you got close, but you missed a few points, you'll want to use this video. All right. If you get everything exactly right, this video may not be needed for you. All right. Okay. So let's talk through this. Company established a petty cash fund in November of the current year and experienced the following transactions. Okay, so let's journalize them. All right, that's what the question is asking for. Prepare the journal entries to establish the fund on November 1st and to reimburse on November 28th. All right. November 1st, establishment of the fund, $200. Debit, petty, cash, credit, cash. All right. Now, a lot of times when I use this demo, a lot of us journalize the transactions date by date, but that's not the way it works with petty cash. And the reason that we can ignore the date is because they're usually relatively small transactions, and so we only record them when the fund is reimbursed, or in this case happens on November 28th. So we'll go through the transactions, but our next journal entry happens on November 28th. All right. Pay $55 to acquire office supplies. Reimburse the company controller for $30 spent on beverages for recruits. All right. Paid $45 for postage, $25 COD for merchandise inventory. All right. Paid $40 for janitorial services. All right. And it says that there's $10 cash remaining in the box on the 28th. So we'll worry about the $10. Let's record each of the expenses. All right. Office supplies. And in this particular problem, if this were a test problem, I would accept either the office supplies asset account, which is what I would interpret what I've written there, or office supplies expense, the income statement account, because either could be correct depending upon the company, if they capitalize supplies or if they expense them immediately. All right. Reimbursed company controller, and this one actually gives you the account, the November 8th transaction. Entertainment expense, $30. Postage expense, $45. $25 for delivery of merchandise. Merchandise inventory. All right, you may remember that from chapters 4 and 5. All right, janitorial. All right. Now, previous problem that we had gave you the over and short. This time we need to figure it out and determine if we need cash over and short, or if we can just, or if they balance out. All right. So we should have, if the dollars in the fund, we should have $190 worth of receipts. All right. When we look at these numbers, it may be hard to see, but that sum of these numbers is $195. All right. So we're actually in the position here where you've got more cash in the box than should be, right? Because there's $5 too much. So since there's too much cash, we credit cash over and short. All right. And the reimbursement is going to take the account back up to $200. All right. So the fund balance is $200. The problem tells you there's $10 in the box, so that's going to be $190. All right. And so we need the 5 because we had $195 worth of expenses. There's our plug to make the entry balance. Right? There was $5 more, so maybe there was an error in counting, or someone was shortchanged during the month of November. But for whatever reason, this is your entry to replenish, to reimburse the fund. Now, after the fund is being reimbursed, you enter the next month, December, with $200 petty cash available for transactions during the month, or at least until the next replenishment entry or reimbursement entry. Okay, so that's our second run through of this. Next time.